Welcome back to another episode. Today, I want to take a closer look at two semiconductor companies that deal in the automotive space, either being electric vehicles, either being autonomous driving. And right now, this market has kind of seen a huge slowdown due to either preliminary results from companies or just actual earnings results showing that there is some form of slowdown impacting the automotive space right now. So, what I want to do is take a closer look at both these companies, explain why they're both down from their overall 52-week high. One of them is down over 66%. But more importantly, some of the growth opportunities that kind of got my eyes interested, or kind of have both of these in my, and why I have both of these on my watch list right now. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so the first one we're going to take a closer look at is Mobileye. And while the stock is only down 5% when we look at it in a year-over-year basis, when we take a closer look from its 52-week high, the stock is down over 36%. And most of the drop happened in late December, early January, after the company announced preliminary results. And we have kind of covered this a little bit, so I am just going to kind of give a little quick background on it. But for those that are not familiar with Mobileye, Mobileye provides a lot of great solutions for kind of the autonomous market. They provide solutions that either being hardware or software solutions to kind of grow the autonomous vehicle evolution. And they have their own kind of system on chips. This is a company that used to be owned by Intel. Well, first was individual, purchased by Intel, and then kind of spinned off as an individual business themselves again. But Intel is still a primary holder here. And obviously that bodes well, right? Because you have a big player like Intel backing you one way or another. But like I mentioned, most recently on January 4th of 2024, the company gave us preliminary results for their fourth quarter. And unfortunately, they did mention that right now they had discussions with tier one customers, and they determined that these customers became aware of excessive inventory, and this is going to cause about 6 to 7 million units to see a slowdown in 2024. And this is causing a lot of negative reaction to their overall earnings. For this quarter four of fiscal year of 2023, there wasn't really much changes, but if we take a closer look at fiscal year 2024, previously this was expected to be over 2 billion, I think over 2.3 billion dollars in revenue. Now they're expecting somewhere around 1.8 to 1.9 to maybe low $2 billion. And obviously this slowdown in revenue is also going to impact their overall earnings to some extent. We can see the big hit is they expect quarter one revenue to be down approximately 50% as compared to what they previously generated in the first quarter of 2023. And they do expect revenue for quarter two through through quarter four of 2024 to be roughly flat to up mid-single digits compared to the same period in 2023, as they expect inventory of their customers to become normalized by the end of 2024. So it does seem like, hey, look, we're kind of getting this over inventory correction here. Quarter one is where a lot of the weakness is going to come for this company in the upcoming year. But quarter two and quarter four aren't going to be much better, either flat or small single digit growth. I do believe one of the big risks here, though, is that, hey, what if the weakness continues in quarter one and also continues in quarter two, right? Because this kind of over inventory came out of nowhere. It only came about it came pretty much at the end of quarter four, at the beginning of quarter one. So investors might be thinking, hey, look, maybe they don't know the full extent of this inventory correction, and it could actually be a lot more weaker than what the company believes it's at right now because of the information that they have. But Mobileye, right, while we understand why the weakness is there, over inventory correction for the semiconductor market is not new, right? This is not new. We usually see these cycles where companies overorder, we start to see a slowdown, and when we start to see that slowdown, that's when we see crazy reactions in stock prices, like we see Mobileye is down dramatically in the past 2 weeks or so, because we're just starting this cycle. But usually this is not the bottom, right? And we can't tell the bottom. Obviously the upcoming quarter could be worse, but I do believe a lot of the negativity has been priced in already. Not all of it, but a lot of it. And usually this is when it's a great time to start to enter the overall semiconductor space. I mean, one of the prime examples is, for example, Nvidia, right? I mean, Nvidia, with the current correction, right, we did see over inventory correction start off in 2021 when the stock peaked at 300 in 2028, and then the stock dropped dramatically due to inventory correction, reaching low $100. Now it's sitting at 547. But this is a prime example of how the over inventory correction happens. Obviously, Nvidia is a special case with AI. Let's take a closer look at another company, right? If we take a closer look at AMD, right? AMD, it peaked in 2021, and then we still saw about a 63% decline before kind of climbing back up a nice amount. So we can see that some of these declines are big and they can continue to happen, but it does already reduce a nice amount of the pain for investors, for those that want to enter now and don't mind waiting for this over inventory correction to turn around. Sometimes the stock prices do tend to react more positive before before the actual market turns around. But when there is kind of a slight change in the tone, things start to look a lot better. So I don't believe, for example, with AMD, I don't believe the market started to turn around in October 14th, but that's when we started to see better results, or we started to see that, hey, look, the bottom was truly priced in. So I know some investors like to wait for, hey, the over inventory correction to be over, but usually when the over inventory correction is over, that's when the stock prices have already gone up a nice amount. And that's just something that I've seen here in the semiconductor space. Now, before we go any further, guys, if you are enjoying the episode, please make sure to hit the thumbs up. Please make sure to hit the subscribe button. I truly, truly appreciate it. Take care, have a good day, and see you next time. Now, the second company I'm going to take a closer look at is Aehr Test System. And I actually just did a video on Aehr Test System where I explain a little bit more about their products. But Aehr Test System, for those that are not familiar, provides kind of a testing semiconductor equipment manufacturer equipment that creates equipment that is used to test chips on the wafer level to help kind of eliminate and improve yields, right? So this helps eliminate any bad chips overall and any bad manufacturing process, and it helps with improvements of yields. And they really focus on the silicon carbide market to some extent, which obviously is impacted by the EV space. Unfortunately, the company did just give us very similar to what Mobileye mentioned, that, hey, look, there is kind of a slowdown happening right now in things like electric vehicle, which has negatively impacted the timing of several and current and new customer orders being pushed out to a later time. They do mention that, hey, look, we are going to reduce our guidance from 100 million to roughly 75 million this year, but in the long term, they're still very, very bullish in the solutions that they have. So again, this is what we start to see, right? Aehr Test Systems, we can see from its 52-week high, the stock is down over 66%. But again, we're kind of seeing that negative trend here. And once we kind of see kind of those bad news really truly priced in, that's when we start to see great buying opportunities for the semiconductor space. And I do believe both Mobileye and Aehr Test Systems have numerous growth opportunities like EV vehicles, autonomous driving, and just the overall auto market in general, in my opinion, is bullish in the long term, right? In the short term, you might see a lot of things like, obviously, high interest rates is going to reduce the amount of people that probably purchase new vehicles. So that's obviously a nice headwind right now. But overall, in the long term, I do believe there's a lot of tailwinds for both these players. If we take a closer look at forward PE ratio for Mobileye, this is the next 12 months because they just started their first quarter of this year. Forward PE ratio next 12 months is 65. Remember, this is the year that's going to be very bad for them. Now, PE ratio forward 1 year, that's about 24 months from now. So 2 years from here, it's 31. I personally don't believe that's crazy expensive, especially if this company continues to evolve in this market. Now, if we look at Aehr Test Systems, current PE ratio forward, they are on their second quarter right now. So for the next 6 months, is 22.84. I don't think that's crazy. And now PE ratio forward 1 year, which is about 1 year and 2 months from now, is 17.47. Now that also looks pretty interesting. Again, if you want to learn more about Aehr Test System, I just did a video on them, so make sure to check it out. I went a little bit more in detail of the company's balance sheet, on the company's kind of growth opportunities. So make sure to check that out. But right now, I do believe these are two companies that if you're willing to get into the EV market, into maybe the autonomous market, or just the vehicle market, and also want to be in the semiconductor space, these are players to watch because they do have the growth opportunity to grow from here. Obviously, I'm not saying the bottom is here, and obviously, I'm not saying these are perfect winners, but I do enjoy the overall risk to reward ratio that they have right now. And I do believe that the probability of them being winners in the long term are much higher right now, as both these stocks have taken quite a hit. So let me know what you guys think in the comments below. Take care, have a good day, and see you next time.